Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and markets have been quite choppy. And the question has been, where do we head next? Are we headed for further downside, or is this a buy the dip opportunities? We continue to hear more and more of that here over the past couple of days. So let's take a look at where we currently sit. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities that we are discussing here today. So we'll take a look at the major equity indices. We're certainly starting to see some market breadth that is improving across the board that we've continued to see here, but this is really starting to emerge with some of the fixed income momentum that we're starting to see, and that has shifts obviously on commodities, but mostly on the sector rotation model. So we'll take a look at which sectors are strengthening, which sectors are weakening. We'll take a look at a couple of subsectors that are currently at risk that I think are worth paying attention to before looking at our bullish market movers and bearish market movers here for today. So let's start off with the S&P 500, which remains on this clear uptrend here, but what has become challenged here is the short-term moving average, if you will, on the longer term chart. And if we zoom into the shorter term chart, we have had, again, the moving average crossover, the 20 cross below the 50, and now we have a rejection here at the 20 and 50-day moving average. That's not particularly strong, especially when momentum here on the daily chart is negative. But momentum here on the longer term chart is still positive. So from my perspective, this is still more of likely to be sideways market action rather than further downside, especially since this 428 level so far has held as support. So further downside, my expectations would still hold this 428 level. However, if the markets break below this 428 level, then all things are likely going to head into a much more bearish tone here. So far we have a mildly bearish tone, but because the long-term moving averages are still positive, we're still trading above this long-term moving average here at the moment, the blue line. Things are not yet bearish, in my opinion. Things are certainly mildly bearish and more sideways action rather than outright bearish. When we look at the NASDAQ 100, things look a little bit worse for the NASDAQ 100. You have the same moving average crossover, the same negative momentum here on the daily chart, but weekly or longer term chart, momentum still remains positive and still remains above the long-term moving average here. So this is really what's important to pay attention to here right now. And for the NASDAQ 100, the main level here is around 352, 354 or so. These are the support levels that the markets have to hold in order to remain neutral. If the markets break below this 352 level, then everything turns fairly bearish. And I would say that we've completed what looks like a bit of a head and shoulders top, and we're headed back towards perhaps as low as 316 or so. We're not quite there yet, but these are some of the really important levels to pay attention to. Now, on the more constructive side, if we see right now as equity markets continue to turn lower here, if you look at small caps continue to trade into this triangle, not showing any weakness. So we're actually seeing small caps outperform the major mega cap indices, the S&P and the NASDAQ 100. And it actually continues to make higher lows here over the past few months. While the S&P and the NASDAQ continues to make lower lows. So this is really a fairly constructive setup that the rest of the market is not selling off with the mega cap names like Apple, Microsoft, Facebook, Netflix, these types of names. They're not selling off along with the major mega cap names. So what that means is that market breadth is actually continuing to improve over the past couple of months. And we've talked about how bad market breadth has become over the previous few months, where the S&P continued to make higher highs, but the small caps did not perform or did not confirm those new highs. It did not catch up, if you will. We saw the same thing here in RSP, the equal weight S&P 500, as the regular market cap weighted indices kept making higher highs and higher lows. We did not see the equal weight indices confirm those highs. We did see a little bit of that over the past couple of months, but on the at the same token, as the market sold off, we did not see these indices sell off here as well. So that's just kind of the market cap indices got a little bit ahead of themselves over the past few months. Now that shift has reversed, so now the equal weight indices are starting to get ahead. So this is causing a little bit more of a balance, a little bit more equilibrium, if you will, and this could potentially be the constructive kind of buy the dip opportunity here that we've been looking for in the equity markets. Previous dips, we were not very comfortable buying them because of the fact of this lack of confirmation from the markets. And now we're starting to see better market breadth on sell-offs here in the equity markets. This is really where we do start to pay attention to as potential buy the dip opportunities in the broader equity markets, but risks still are there. When we look at the bond market, we've had this double top here around 151. It's now broken below the trend line here, or rather the support line here. This would traditionally target here to the downside, minimum targets of about 140 or so. We're just about shy of there, but it could have extended targets down to 135 or so. But we have started to see momentum slow down a little bit. Lower lows in price, no longer seeing lower lows in momentum. So this is something that we could see more of a slower grind lower here to the downside rather than this quick and fast move that we've seen here over the past couple of weeks, which is starting to lose some of that momentum here to the downside. If we look at yields currently trading at 161 basis points, it basically is back to the equilibrium that we traded in for about a couple of months, 3 months or so, before yields started to tumble here in the beginning of the summer. So we're back to where we were a few months ago or earlier in the year. And, equity markets were not much weaker at that time. So, the yields at 161 basis points in itself is not quite enough to be concerned about the markets at the moment. If we see yields break above 175, we have inflation numbers coming out here today. These are the types of concerns that could start to see yields rise, but we're not seeing that just yet. The dollar index has broken out above the $93 level and has continued to move higher here. This is one that we have to pay attention to because higher dollar does have ramifications on commodities, has ramifications on emerging markets and the emerging market debt that they hold. So this is one that we do have to pay attention to, especially for equities internationally. Equity companies that hold dollar-denominated debt. A higher dollar is going to be a concern for those types of companies. The other thing that we do still have to pay attention to here are commodity prices. Gold continues on this downtrend here. As I've been talking about this downtrend for a while here, basically when we get the top end of the range, those are basically selling opportunities. Bottom of the range are potential short-term buying opportunities. We recently just reached the top end of the range. So we're heading back towards the bottom end of the range here right now if we look at the short-term charts. The only difference here for commodities has been oil. Oil has been on a supply strain issue here at the moment that's causing energy prices to skyrocket. Pretty much any type of these fossil fuels right now have started to see significant moves to the upside. Coal, natural gas, crude, and these supply constraints are not likely going to resolve themselves anytime soon. So we've had the breakout, we've come back to retest this as support, and now it's continuing to move higher here. It's losing a little bit of momentum, taking a bit of a pause here, but long-term, our views is still for crude and fossil fuel energy prices to continue to move higher here. And then when we look at the sectors, this is really where we start to see a little bit of improvement from the sectors from last week. Last week, we had 6 long-term bearish sectors. Here this week, we only have 5. And one of the movers here was consumer staples as we move from long-term bearish to neutral. And then we also have consumer discretionary that moved from neutral to bullish in the long-term trends here. We also have last week where we saw both industrials and what am I looking for? Industrials and materials. Both of these had negative trends here. Both this week, they're more neutral trends here. So we've seen a shift here, both from industrials and materials. So things are starting to look a little bit more positive here overall for the sectors, despite the kind of shifts that we've seen here in the broader markets. So, this does not quite make a trend, but they're starting to show some signs of an improvement. Hey there. Thank you so much for watching. I really hope that you enjoyed today's session. If you want to watch the full recording and all of the market mover symbols that I covered today, register for an account at OptionsPlay.com. You will access my daily trading signals to follow along and weekly options education sessions to improve your trading skills, and gain full access to our platform to analyze the risks, rewards, and probabilities for any trade. Regardless of where your ideas originated from, filter them out with OptionsPlay and start gaining confidence in your trades with our platform. And the best part is that you can start completely free with a 30-day trial. Click on the link in the description below to learn more. And as always, have a great trading day.